Consumer credit growth is significant in understanding economic trends. This occurs when individuals use credit cards or loans to purchase goods and services without immediate payment. However, if excessive consumer borrowing becomes widespread, it can lead to financial instability, such as increased debt levels and potential defaults, which may negatively impact the economy. Subject: Consumer Credit Growth Analysis. Passage to fact check. Let's start with the basics. Consumer credit includes things like credit cards and loans for cars or furniture. When you use these options, you're essentially borrowing money from a lender to buy something now but paying back more later because of interest rates. Now imagine your wallet is full of plastic instead of cash. Each time you swipe that card, it may feel convenient and rewarding in the moment, but what happens when you don't pay off those balances at the end of each month? You begin accruing interest on the outstanding balance, which can lead to accumulating debt over time if not managed properly. Here's a real example. Let's say you charge $1,000 on a credit card with an annual interest rate of 20%. If you only make minimum payments every month, it could take over 5 years to pay off that balance. And guess what? By then, you'll have paid back more than double the original amount because of compounding interest. So why does consumer credit growth matter for our economy? Think about it this way. When people are spending more on credit cards and loans, they're not saving or investing as much of their money. Instead, they're using it to pay off existing debt, which can limit their ability to build wealth through savings and investments. Let's zoom out to see the bigger picture. Before the financial crisis of 2008, consumer credit growth was indeed increasing significantly. People were using credit cards extensively to purchase items beyond their immediate cash means. However, what often follows when a large portion of the population accumulates substantial debt is an economic downturn, as seen during and after the 2008 crisis. The answer is a recession. When individuals and businesses cannot repay their debts, banks become reluctant to lend money freely. As a result, consumer spending decreases because people prioritize paying off debts over purchasing goods and services, leading to reduced sales for businesses. Now let's talk numbers. In the United States, consumer credit grew by over 10% annually from 2004 to 2007 before the financial crisis. That might sound good, but it's like pouring water into a bucket with a hole in the bottom. It just keeps leaking out. What does this mean for you? If you're carrying too much debt, especially high-interest credit card debt, it can significantly harm your financial health. It's like letting a leaky faucet drip until the entire bathtub overflows. At first, the dripping may seem minor, but over time, it becomes overwhelming and uncontrollable. So how do we avoid falling into this trap? One way to prepare for financial stability is by building an emergency fund. Even a small amount set aside can make a significant difference during unexpected expenses. It's like having a spare tire in your car. You don't need it all the time, but it certainly comes in handy when you get a flat. Another strategy is to avoid unnecessary debt. Instead of buying something on credit simply because it feels good right now, ask yourself if you can afford to pay for it with cash immediately or soon after the purchase. If not, consider waiting until you can. This simple act can help you save money over time by avoiding interest and finance charges associated with credit purchases. But here's the thing, even if you're cautious, major economic shifts can still impact you significantly. That's why understanding consumer credit trends is crucial. It helps you identify periods of stability and potential downturns. For example, in recent years, we've seen a surge in personal loans, particularly those advertised as solutions for debt consolidation or emergency financial needs. However, these loans frequently carry high interest rates and fees, which can lead borrowers into a cycle of debt. Let's look at a specific case. Imagine you have $10,000 worth of credit card debt. A personal loan might offer to consolidate it all into one payment with an APR of 15%. Sounds better, right? But here's the catch. If you can't pay off this loan quickly, those fees and interest rates start adding up, potentially increasing your total debt over time due to compounding interest. Now let's compare that to a different option, paying off credit card debt gradually but steadily with smaller monthly payments. Depending on the interest rates in terms of both the credit cards and the personal loan, you might end up paying less overall in the long run by choosing this route. However, the total cost will depend on various factors such as the interest rates and the time it takes to repay the debt. This is where understanding interest rates and associated fees truly matters. High-interest debt can trap you in a cycle, pulling you deeper into debt faster than you might realize. While a steady repayment plan may appear unexciting, it effectively outperforms seemingly attractive but costly alternatives over time. Let's break this down with some numbers. If you have a $10,000 credit card balance at 20% APR and make minimum payments, typically around 2 to 3% of the balance, it could take over 5 years to pay off and you would end up paying thousands more in interest. But if you switch to paying just $350 per month on a personal loan at 15%, assuming no other fees, it might take approximately 3 years to pay off the debt. Sounds better. Not quite. Here's the kicker: with those higher monthly payments, there's an increased risk of missing payment deadlines or incurring penalties due to the added financial strain. These extra costs can quickly accumulate and potentially negate any savings from a lower interest rate. So what does this mean for you? It means making wise decisions with your money. Rather than relying on tempting debt options, concentrate on gradually reducing your debts. This approach may lack immediate appeal, but it's effective and helps maintain control over your financial situation. Now let's talk about inflation. Inflation reduces the purchasing power of money over time, making goods and services more expensive. If you're carrying debt during periods of high inflation, it can become increasingly difficult to repay that debt as the cost of essential items rises. For example, if prices rise by 5% annually and your income doesn't increase at the same rate, the purchasing power of the money you set aside for debts may decrease more rapidly. This situation can make it harder to manage your payments effectively and avoid accumulating more debt. So how do consumers manage debt? One key strategy is to build a diversified investment portfolio. Investing in low-cost index funds can help you grow wealth over time by providing exposure to broad market returns, which tends to outperform actively managed funds on average. Index funds also offer protection against inflation, as they track the overall performance of an economy and its stock market, rather than being directly affected by price increases. But here's the rub: even with smart investments, high debt can still be a drag on your finances. It's like trying to cycle uphill while carrying heavy bags. It becomes harder and slower. So let's revisit the concept of an emergency fund. Having some cash set aside for unexpected expenses can prevent you from needing to take out new loans or accumulate more credit card debt when emergencies occur. It serves as a buffer that helps you maintain financial stability during difficult times. Now let's look at the long-term effects of high consumer credit growth. Economists often use something called the debt-to-income ratio to measure this. When this ratio rises too high, it signals that people are taking on more debt relative to their income than is sustainable. And guess what? That's a red flag for economic instability. For instance, during the 2008 financial crisis, consumer credit growth surged as many households borrowed beyond their means. When the economy deteriorated and jobs were lost, those debts became insurmountable burdens. This is why tracking these trends matters. It helps identify potential problems before they become crises. So what can we do to avoid repeating history? First, stay informed about your financial situation by regularly checking your credit report for any unexpected changes or errors. Understand your current debt levels and budget accordingly to manage your finances effectively. Second, be proactive in managing your finances. Set up automatic savings plans and adhere to a budget that prioritizes reducing debts before spending on non-essential items. Third, educate yourself about financial tools and strategies. Understanding how different types of credit function, the impact of varying interest rates, and the long-term benefits of saving can significantly improve the health of your finances. Remember, every dollar you save is a dollar less debt you'll need to pay off in the future, and that's often more valuable than any flashy loan offer or credit card perk. In short, keeping track of consumer credit trends is like having a weather forecast for economic conditions. It helps you anticipate changes in the financial climate and prepare with the right tools to manage any challenges that arise. So keep an eye on those numbers and stay vigilant about your debt levels. By doing so, you'll be better equipped to manage through any economic challenges that arise. This approach helps protect your financial stability over the long term. This is educational and historical, not financial advice. Consumer credit growth can reveal patterns that might seem counterintuitive at first glance. For example, when credit availability increases dramatically, it often leads people to believe they're wealthier than they actually are because they have access to more money through loans and credit cards. However, this easy access can mask deeper issues such as rising debt levels and overspending. Consider the housing market bubble that peaked around 2006. Easy credit terms allowed many people to purchase homes beyond their means, driving up prices artificially. When the bubble burst in 2007 to 2008, millions faced foreclosure, losing both their homes and significant portions of their savings. So while more accessible credit might feel like a boon at first, it's crucial to consider the long-term risks. High debt levels can leave you vulnerable during economic downturns when interest rates rise or job security is uncertain. In these scenarios, the cost of maintaining that high debt load becomes painfully clear. For instance, if your monthly payments become unmanageable due to a sudden decrease in income, you might be forced to take on additional debt just to cover basic expenses. This can create a vicious cycle where each new loan or line of credit adds more financial strain, digging you deeper into debt. Instead, focus on building an emergency fund and paying off existing debts before taking on new credit. An emergency fund acts as a financial cushion, allowing you to cover unexpected expenses without relying on high-interest loans or credit cards. By doing this, you're setting yourself up for long-term financial stability rather than short-term comfort. In short, the conservative approach of saving and reducing debt consistently outperforms the allure of easy credit. It may not be exciting, but its effectiveness is undeniable when it comes to managing personal finances. This is educational and historical information, not financial advice.